Okay, welcome everyone to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. I'm your host today, John Lai, and welcome to today's episode, Private Lending with Kevin Amolsch. Before we begin, a quick disclaimer, we are not financial advisors. All investments are subject to risks, including the possible loss of money you invest, so perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before beginning investments. Today's guest is Kevin Amolsch. Kevin is a successful real estate investor and private money lender. He earned his degree in finance after serving 4 years in the U.S. Army. Thank you for your service. After college, Kevin spent 2 years working with Wall Street as a mortgage bond analyst before leaving to work in real estate financing for investors full-time. With 2 decades as a real estate investor and 16 years in real estate lending, Kevin and his companies have closed on over 2,200 transactions as a buyer, seller, or private money lender. And he currently manages multiple mortgage funds with more than $750 million in closed loans. Thank you very much for being here with us, Kevin. We gave you a bit of your background and your experiences, but could you provide a little bit more detail on your background and how you got to where you are today?
Yeah, John, I appreciate, first of all, you and all the listeners and guests. I know you could be doing a lot of different things with your time, and you were kind enough to invite me on here to try to help. And people are kind enough to take an hour or whatever this is going to be to listen in. So I just really, really appreciate that. And I promise to do the absolute best I can to bring the energy, the excitement, and the information that you're looking for. So I'm going to go ahead and switch the slide if that's all right, because the next slide here is my disclaimer and then a little photo of me and my family. So you asked me to tell you a little bit about myself. So I got started in real estate at a super young age. I was just turning 21 when I bought my first property, fresh out of the military. In fact, I was still in the military at the time, but I knew that I was exiting and I was going to want a place to live. But while I was in the Army, I was reading books about investing because I had a small savings account, and all the books I was reading was pointing to real estate as one of, or maybe the best investment to make money. So at first it was just going to be a little investment for me. I wanted to buy a couple of rental properties and I was going to go out and get a job in finance. And then I was just going to do that. Well, as I mentioned, I bought that first house and I just saw the power of real estate. I saw the appreciation, the tenants paying my mortgage off, the tax benefits, and the cash flow. And I decided, this is more than just a simple investment. You could really turn real estate into a career. And so I decided to do that. And I started buying 1 or 2 houses every single month. But here it was, a broke college kid. I mean, literally my refrigerator at the house had a keg of beer and a can of beans. I mean, I didn't have food at the house, like most broke college kids, but I was still figuring it out. 1, 2 houses a month. And what I learned from that process is the passion for real estate that I have has to do with the financing, because the financing in real estate is the deal structure. So I enjoy meeting with people, talking through a transaction, trying to find a solution, a win-win situation. And all of that has to do with the financing. So I just naturally, organically moved to the financing side of the business. And I started raising private capital. And this was back in 2006. I was working with a lady named Susan. Susan was amazing. She took me under her wing. She's definitely one of my mentors. And she taught me the business. But then 2008, when the crash hit, she decided to get out of the business. And I'm a deal guy. I wanted in. So we separated and I started Pine Financial Group. And as you mentioned, we're well over 2,000 loans. It's actually getting closer to 2,500 transactions at this point, almost $1 billion in business, because we've just been raising private money and lending it out. So I absolutely love the debt business or the financing side of the real estate investment business. And that's exactly what we're going to be talking about today. Did that answer your question?
That did. And great. Thank you for that background. Go ahead and
just go ahead.
Yeah.
All right. So I got my own disclaimer here, John. I'm not This is we're talking about a security here. It's not black and white. I mean, it's not gray. It's definitely black and white. This is a security. So I need to be very careful here. Everything I'm doing today is for educational purposes only. I'm not making an offer. I'm not making any kind of offer to work together, any kind of offer of an investment. If there's an opportunity to work together, great, but there's a little bit of a process we have to go through according to some of the regulations of the government. The government's out there to protect us, right? So we have to go through some steps here before we can work together. So that's the disclaimer. This is my family. I actually just got engaged just a short 1 month ago. We were out in Germany and I proposed. And so she has 3 kids. I have 2. So we have a blended family of 5 kids. There they are.
That's great.
And it's interesting. I've been traveling a lot lately, John. And I think, you mentioned right before we hit record here that we wish we had a little bit more time to advertise this webinar. And I agree with you, but I was climbing Mount Kilimanjaro out in Africa. So I just got back yesterday and super excited to be here. So topics. What is private lending and why do investors love it? We're going to talk about the nuts and bolts. So this is really like, how do you actually get into the private money or hard money business as a passive investment? So I want to make sure I walk through the steps involved and some of the risks. Differences between private lending, individual notes or trust deed investing, you often hear it called, and a debt fund. And I think that's the main 3 topics here. So why do investors love the private money lending business? And why did I get into it? Well, actually, what is it? So here's what it is. I got to actually move something here because it's right in my way. I'm going to move you over here, John, because every time I was looking at my slides here, I was looking at. Yeah. So a loan to an individual or entity, it's really a simple concept. So private money lending is just one individual loaning to another individual. Now, what we're talking about here today is that a loan from one person to another, but it's all going to be secured loans, secured by real estate. So private lending doesn't necessarily need to be real estate lending. You could loan somebody money to go buy a car, or you could loan your family $500 to do whatever, right? And that's just a transaction between 2 individuals. So that's really what we're talking about here. It could be secured or unsecured, as I said, and the terms vary greatly. Now, in the real estate lending business, you will see it's the most secure type of lending there is, hands down, because real estate doesn't move around. I mean, it's there. You could go out and see it. You could touch it. You could rent it out. You can insure it. It's just a fantastic piece of collateral. But you get a high return with real estate lending as well. So I put here on the slide 10 to 12%, those are very, very common returns in this industry, but you could see them much higher. So I might say, hey, you'll loan another individual money to do a real estate transaction at 10%, which is a fantastic return. But you could also potentially charge origination fees or points. We call them points. A point in a fee is 1% 1% of the loan amount in a fee. So let's say it's $100,000 loan and you charge 2 points. That'd be $2,000 in additional revenue. And what a lot of people don't know or understand so well is that you could actually partner on these deals too. So I could loan you money at a low loan to value, maybe 65, 70, 75% of the property's value. So I'm nice and safe, and take a little bit of an interest rate and potentially some of the upside. So if there's profit in the deal, you could get a piece of the profit also. And it's very easy to secure these partnerships because you're having the borrower sign a note and a security instrument, which would be a deed of trust or a mortgage. So I know I'm going very fast here. I'm going to get a little bit more into the paperwork a bit later, but just please understand that you could do a partnership and secure it with a lien on the property, which is very different than most types of partnerships with like joint ventures or LLCs or something where there's not real teeth in the collateral.
Right.
So that's just another reason why private lending is so fantastic. So why do people love it? Well, we talked about it a little bit. The high returns. So it's not uncommon to get double-digit returns, very steady and secure. It's passive. So I talk to people all the time, John, about real estate investing and how passive or not passive it is, right? People think, well, I'm going to own some rental properties. I'm going to go out on the beach. I'm going to sip my cocktail with that umbrella drink, put my feet in the sand, and I am going to be making money as I own my rental properties. Well, that's mostly true. That's mostly true. I love real estate. I own a bunch of rentals also. But let me tell you what, it is not passive. There's your tenants. What do we call them? You're going to be dealing with tenants, toilets, and tantrums, right? Because the tenants are going to complain about different things and lock themselves out at night, want you to come and unlock the door for them or whatever it is, but it's certainly not passive. And yes, even property management companies don't make it passive. I live in Denver and I owned 8 properties out in Memphis, Tennessee. And because it was not in my own backyard, I decided to hire property management for those 8 properties. But I got to tell you what, those 8 properties were more management intensive than the properties I have in my own backyard. There was something about managing the manager that's very challenging in that specific market. And I went through quite a few and there was not much difference, honestly, between them. So yes, you could hire a manager and that should help it be more passive, but you still have to manage the manager. So it's certainly not passive, 100% passive. Private notes, for the most part, is really passive. I mean, unless you count going to the bank to make your deposit work, there's just not a ton of work in private lending. So if you want to be on the beach, while you're earning income, this might be the business for you. You have access to deals. So the cool thing, and we're going to talk about this too, but the cool thing about private lending is you're not out there hunting for deals, right? Real estate investors are always out looking for deals. They're spending lots of money in marketing to get sellers to call them, to find off-market deals. They're spending lots of time with real estate agents and realtors out there making offers. They're out there hunting for deals. As the lender on deals, you don't necessarily look for them. Your clients, your borrowers are out there finding the deals for you to participate in. Cash flow. Rental properties are great, as I mentioned, but they don't cash flow all that well, especially with the lending environment we are in right now. Rates are high, and quite honestly, even though rents are up, they're not keeping up with interest rates. So that's really deteriorated cash flow. But in the private lending business, it's pure cash flow. Secured, like I mentioned, secured by real estate, which is insured. It's tangible. You can rent it out. And what I really love about housing, I do both residential and commercial, John. And what I really love about housing in this current environment is it's somewhat insulated from all the noise that we're hearing and all the speculation of the recession that's coming. I actually think that we're probably already in a recession. When I was in school, you had 2 negative GDP quarters, and that was considered a recession. Well, we've had that several times. And we have seen housing prices go down significantly, and then they pop back up again, right? So they're down off their peak, but they're not down that much. And not all recessions, quite honestly, hit real estate. In fact, you'd have to look back to outside of 2008, which was a direct attack on real estate. You'd have to look back to the 90s before you see another recession that really hit real estate. And that was the savings and loan crisis. So it's very similar to the savings and loan crisis was in the 80s. So let me just clarify. But the recession that hit real estate came from that, and that hit in the early 90s. So I like housing, and where I was going with this is I really like housing right now because we have an inventory issue across the nation, and real estate values of any commodity come down to the fundamentals, supply and demand. And if you have a lack of supply, that creates a floor for what the value will go down. And quite honestly, real estate housing is pretty liquid. You can get rid of that stuff fast if you price it correctly. Very different than in the commercial world. And then finally, real estate lending is stable. So you're not going to see the ups and downs in the stock market. And we're going to show you some graphs on that later today as well. But it's just very steady Eddie. We like to say steady Eddie. So if you're looking for some stability in a portfolio, this is absolutely one of the investments that will bring that. All right. So the nuts and bolts, how do you actually do it? There's a 4-step process here. It's finding the deal, which I already touched on a little bit, qualifying the deal. So I want to spend some time here, make the investment, and then service it. So how do you find the deal? Well, I mentioned you're not finding deals, guys. Your borrowers are finding deals. So your job is to go out there and find the borrowers. So how do you do that? The best way is networking. I put on here realtors, friends and family, real estate investment groups or clubs, associations. Real estate associations, you guys, is probably the best way to find real estate investor clients because the room is full of real estate investors. Everybody in the room is a real estate investor or they want to be. So those are the types of rooms that you want to be in. Title companies, these deals fall apart. Off-market deals especially fall apart right at closing regularly. Financing falls through, other private lenders commit, and then all of a sudden can't close. So I get a lot of deals from title companies. Just call me and say, hey, this one fell apart. We have a willing buyer, willing seller, any interest in helping them fund it. So network with title companies and then wholesalers. A wholesaler is a real estate investor that maybe they're just kind of getting into the game, or they're really just like to focus on finding transactions. They don't want to necessarily rehab houses and deal with contractors and tenants. So they're out there looking for high quality real estate deals. And now let's say they get one, keep the math real simple. Let's say it's worth 200,000. They could find it. It needs work, but it's worth, after it's all fixed up, 200. They can negotiate a fantastic deal at $100,000. Well, maybe they'll flip that to another investor that wants to do the rehab, the fix and flipper, and mark it up maybe $5,000-$6,000. So let's say I get under contract for $100,000, John, and I'm going to sell it to somebody for $105,000. So I make my quick $5,000, never have a penny in the deal, never have my credit pulled, my income documented, don't have any of that, don't have any risk. So they're just out there finding wholesale deals and selling them to flippers that will bring the deal to a retail status. So I hope I explained that well. But wholesalers are fantastic people to network with because their client is fix and flippers, which is exactly who we're looking for.
Yeah. So do they bring you to the deal, introducing you to the fix and flippers then?
Yeah, that's exactly right. So if I'm a wholesaler, I want to make sure my fix and flipper can close, right? So the money is a pretty vital piece of that. So as a wholesaler, I might want to build relationships with hard money lenders. So if I have a good deal and you're telling me you're a fix and flipper, I want to make sure that you can close. So I might introduce you to my hard money lender just so that I know that the money is going to be there.
Yep. And the title companies is a good referral. I didn't even think about that, some deals might fall apart and they need a private money lender, a hard money lender to kind of sometimes step in and help out the actual deal itself, help to close.
Yeah. And the same thing with realtors, right? Because look, nobody gets paid if the deal doesn't close. And who's got the most money to lose if a deal doesn't close? It's the realtor, right? So they want their commission. So if deals are falling apart, they definitely want to get to know you.
Yeah.
And then obviously friends and family and real estate clubs, we talked about that. But so all the networking is fantastic. But what I've done, what I've had the most success with is something similar to what we're doing right here, John, where we just teach people how to be better at what they're doing, how to be better investors. So I would get in front of a room and do a seminar, 2-hour seminar on fixing and flipping. So how to run the numbers, how to stay safe, how to go out and locate projects, how to negotiate, like how to do the fix and flip business. And I really don't ask for anything in return. I just want to give as much as possible, give as much value as possible and help people become successful. And when I do that, they are attracted to me. They want to work with me. So it's a fantastic way to generate leads if you're willing to teach people and help people how to be successful. You could advertise. Other than TV, John, I think I've tried it all. So lots of direct mail, lots of pay-per-click advertising, lots of flyers, and we did radio. We've done quite a lot of paid and free advertising, a lot of Craigslist and OfferUp and Facebook Marketplace and all of the stuff that's free also. So I would say do it. Especially the free stuff, right? Because it's free. But even the paid stuff, maybe dabble in that. But I think you're going to get much better luck here in networking and seminars.
No.
Okay. Mortgage brokers and private lenders. Go ahead, John.
I was going to say, a lot of these, like networking is within your region, your MSA, or maybe even a couple of states out. But I would imagine like seminars and potentially advertising, you could get further out than your typical MSA that you would deal with. How much, and you'll probably get to this later on, how much of your territory do you cover outside of your existing couple of states where you're located?
Yeah, and I'm going to answer that in two ways. First of all, we have 4 target markets. So we're in Colorado, Minnesota, Washington, D.C., and up in Wisconsin. There's a little story. There's a little story for each of those expansions. Obviously, Colorado, because I'm here. But I think as a private lender, you definitely want to either really understand the market, so maybe only loan in your backyard, or work with someone who understands the markets they're lending in. And the reason I say that is because if a property does come back, or if there is a default, you want to know and understand like how to get out of that problem. So do you have the realtor that will help you create a rehab plan? Do you have the contractor that will execute on that plan and get a property ready to list? And do you have people, you have title, you have all of the team necessary to get you out of a jam? Now, the second piece of that is all of this networking that I put on this slide is like in-person networking, because honestly, that's how I've been doing this for 20 years, right? So this is how we used to do it. Doesn't always have to be online or offline, right? There's a lot of online networking too. So you can hit different MSAs just from online forums. So Bigger Pockets, by far the biggest website for fix and flippers and real estate investors in general. And there's going to be lots of different people on there that you might want to get to know outside of your MSA also. I separated here, John, the mortgage brokers and private loan brokers for a couple of reasons. So, and the main reason is you will find more hard money lending opportunities with these two than anything else that you do. So to give you an example, mortgage brokers, a true mortgage broker, they're going to be limited to the guidelines of the lender they're selling the note to. So let's say it's a Wells Fargo. Well, Wells Fargo has a little box, right? And they got to stay inside this box. If there's an underwriting guideline that's outside the box, the answer is no. And they don't have any flexibility. So it's not real common sense. And I like to call what we do common sense underwriting. So let's say we're outside the box a little bit, but there's a very clear path to repayment, then we want to do that loan. Wells Fargo has a very strict box, right? So one of the things at Wells Fargo, and I know I'm picking on Wells, but it's really any bank, any bank, or Fannie Mae or Freddie Mac, any bank that has the box. One of the boxes is, and this is almost universal, the property has to be habitable. That's the word that's used in the industry, habitability. So if the appraisal comes back and he checks the box that says it's not habitable for whatever reason, then the lender is going to deny that loan. So real quick story. This was early on in my career, within 1 year of me starting. This is before I even started Pine Financial. So I was still working for Susan at the time. Within 1 year of me starting, and I had a client or a mortgage broker call in and say, I need your help with a client. They have a house under contract. It's a fantastic deal. They're going to rent it out. And I looked at the numbers, and thing's going to cash flow $1,000 a month, which is a great number for a single family rental property. The problem is there's no closets because the previous owner went through foreclosure, got pissed off, and took a sledgehammer to the walls and just ripped through stuff. And they ripped through like the closets, and the shelves were down and the doors were off. And so there's nowhere to hang clothes. Well, one of the things in Colorado to have a conforming bedroom is it needs a closet. With a no closet, it's not considered a conforming bedroom. So no conforming bedrooms means not habitable, which sounds ridiculous, you guys, but this is really what happens. So the mortgage broker could not get the loan approved. So called me. We went in there and said, okay, for $500, we could reframe in a closet. And all of a sudden now it has a bedroom and it's habitable. And now you could do the rest of your rehab and rent it out. And it'd be a fantastic opportunity. So I got the first loan, the rehab loan. He fixed up the property, sent it back to the mortgage broker. He refinanced it with a Fannie Mae loan, paid me back. So we both won, and the client was able to get the rental property that they wanted. So that's just one example, and that happened early in my career. But I've seen times where there's no stove in the property. I don't know when the last time you went into a foreclosure and there was working appliances, but that doesn't happen very often.
Right.
And so there was no stove, no way to cook, no way to cook food. So the appraiser marks it as not habitable because you can't cook food. So something as simple as a $600 stove, and all you do is plug it into the wall, changes the deal significantly, right? So that's why I say mortgage brokers are a fantastic referral source. And then private loan brokers, that's similar to what I do. Now, we sell loans now, but when I was getting started, I would say, okay, John, you have $100,000 and I have another person over here, a rehabber over here that wants to rehab a house. So you have 100,000, they need 100,000. I would just bring you together and charge fees, and then maybe share the fees with you. Maybe I keep the fees and just give you all the interest, or whatever the arrangement is. But that would be a broker situation, right? I'm just bringing the two of you together and I'm charging a fee to do it. So there's private loan brokers out there, but the industry has evolved significantly since I was doing that. So now what we see a lot more of is hard money lenders originate the loan with their money, get it all done so it's nice and packaged up, and then sell the loan to an individual investor. So now instead of brokering to an individual, we're selling loans to individuals, but it's basically the same thing. Again, a great way to get access to loans. All right, qualifying the deal. So how do you know you're making a safe investment? So the first thing we look at is the financials. So what I'm looking at here is a personal financial statement. And you could have like some fancy application process, or you could just say, hey, client borrower, send me your personal financial statement. We're looking for 4 things when we have this financial statement. We want to see income, we want to see assets, we want to see liabilities, and we want to see expenses. So obviously your income minus your expenses creates what your excess cash flow, and then your assets minus your liabilities creates your net worth. So this gives us a real good picture of your financial strength. Now, well, I'm going to say the supporting docs, I should probably put this one second, because you're going to tell me all about your financial situation in your financial statement, right? But I'm not going to just take your word for it. I mean, trust but verify. Have you heard that term? Mm-hmm. So what we do is we look at supporting docs. So you said you make this much money. Okay, let me see a quick tax return. You say you have this much in liquidity in your bank account, an asset. Well, liquid asset is hugely important in lending business, because if you don't have liquid assets, then you don't have reserves. And 99.9% of rehabbers go over their budget. I'm telling you, you will go over your budget. Your clients will go over their budget. If you don't have the cash to handle that overage, then you end up with a property back. So make sure your clients have some cash reserves and verify it with a bank statement. Credit report. So just, I guess I want to touch on this. What is a good requirement? Because I know I could hear people asking, well, how much should I look for? We require 10% of the loan amount in liquidity. Okay, credit reports. I pull all 3 credit bureaus, and we're looking for, so we call it a tri-merge. So you can get a tri-merge credit report. It's a little bit more expensive, but the benefit here is if there's a judgment, or sometimes a default on a loan, it sometimes only gets reported to one of the bureaus. And so if you're only looking at one credit report, you might miss important things like that. And we want to know if there's judgments against a borrower, right? Mm-hmm. So I suggest pulling all 3 credit bureaus. Now, we just recently, with the changing environment, started looking at credit scores. So we have a 650 minimum credit score requirement now. We didn't have that before. What we were really looking for is potential risk down the road. So is there a bankruptcy looming in the background here? High credit card usage, high credit card debt, maybe a beginning of defaults on credit cards or car loans, that kind of thing. Less about what's happening or happened 3 or 4 years ago, because people have trouble and then recover. What we're looking for is what's it looking like right now, or potentially what it could look like in the coming year or so as we have this loan with the client. Title commitment. This is going to be the title company committing to insure your lien position. So there's 2 types of insurance policies when we're talking about title insurance. And I should back up and say title insurance is a very unique insurance policy, because it's the only one that exists that insures against everything that's already happened, right? You think about car insurance, life insurance, health insurance. Well, like this is all insuring for potential risks in the future that you can't see, right? Title insurance insures all the stuff that happened in the past. So what we're looking for here, is my borrower getting clean title? And is the seller the one that's signing the deed to transfer the title? Are they the authorized person to be doing that? So that's really, and there's no other easements or judgments or liens or anything else against the property. So that would be like the owner's, we call it the owner's title insurance policy. Now the lender's title insurance policy is ensuring your lien as the private or hard money lender, making sure that you have the appropriate lien position. So what we're looking for here is any exceptions to the title policy. So you'll get a lender title commitment and you'll read the exceptions, because anything that's listed as an exception is not insured. Everything else is insured. So it's really kind of easy to read compared to like property insurance and that kind of thing, because it just assume you have the first lien position, no matter what, you're going to be insured, and then read, well, except for this easement, these oil rights, these whatever it is, and there's a whole list of them, right? So be sure to read those exceptions and understand them, or hire an attorney to do that. Because what you might find on there is another lien that they're taking exception to, and then you're not going to be in a senior position, or not the position you're expecting. There might be a mechanic lien or something, for example. So you just want to make sure that there's none of that on the title commitment. Appraisal. I highly recommend getting an appraisal, because this is a third-party opinion. Now, it is just an opinion. I get it. It's not, doesn't mean necessarily that is the exact value of the property, but we're talking about a licensed individual that's trained to come up with valuations, and they're telling you what their opinion of the value is. And it has a ton of information, like the FEMA flood map. So if you're going to be in the flood zone or not, the zoning, is it appropriate and legal zoning? Where are the utilities coming from? I mean, there's quite a lot of information in one of these reports, and they're not that expensive, $500-600 right now. So highly recommend getting an appraisal before you do any loan against real estate. Repair estimate. First of all, you need this for an appraisal, because what we do in this business is we look at the after repaired value. Everything we do is based on what it's worth after it's all fixed up. So how do I know what that property is worth after it's fixed up if I don't know what the fix up is going to be? So I need a very detailed description of, we call it an executive summary. Are you adding any bedrooms? Are you finishing the basement? Are you replacing roofs, windows? Like what's the summary? What are you doing? What's going to be the new livable square footage, bedroom, bathroom count, all of that. And then give me the budget. I want to see how much you're spending in the kitchen, how much you're spending on each bathroom. And then I provide this to the appraiser. They need that to come up with the after repaired value. And it's a great way to start. It's a great way to start looking at what it costs to rehab houses. And then after, it doesn't take long, after you start reading these scopes of work or repair estimates, you'll start seeing how much it actually costs. And then you'll know, like you guys are under budget here and here, and you'll be able to tell your borrower, like, we need to beef up this budget. You don't have enough money set aside for certain things. And you could always have your contractor review a scope of work and see if they're accurate or not. Insurance, this is one, I think it's going to be on my mistakes slide, because I do see quite a lot of mistakes on this. You definitely want property insurance. So this is separate from the title insurance. This is going to insure the property itself. So if there's a windstorm or hail or a fire, I had a property that was on the news, the TV twice. One of them was because of fire in the attic. Squirrels ate through some electrical cords, and I guess it was shorting or something, and it started the roof on fire. Mm-hmm. You need to have insurance for that. So the piece of advice here is make sure you have the correct insurance policy, because what insurance agents don't understand, a lot of them, is the fix and flip business. So they sell, a lot of times they sell landlord policies to your client, your fix and flipper, and that's not providing the insurance you need, because landlord policies have what we call a vacancy clause in them. And a vacancy clause just says, hey, if the house is vacant for 30 days or 45 days or whatever the number is, or more, there's no insurance. And the reason they do that is because vacant properties carry a significantly higher amount of risk than occupied properties, especially if you're talking about contractors in there with power tools and crawling on ladders. So there's a lot more risk, and we want to be sure we're insured correctly. So we want, John, we want a vacant property policy or a builder's risk policy, one of those two. The difference is if you have some liability coverage or not.
Got it.
So talk to a good insurance agent and just make sure that they understand the property is going to be vacant for the entire time of ownership and it's going to be under construction. All right.
Now, this is a fantastic list. The question I had was, do you, when evaluating specific opportunities to engage in the private financing, do you have a shorthand? Do you have like the 2, 3, 4 key metrics that you're looking at?
Yeah, so there's two things here. There's two things that are super important before you spend any time on a potential transaction. One, make sure that your borrower actually has the liquidity. So I threw out there the 10% of loan amount as a minimum. That's after closing. So if you're going to require that your client bring in money to get the deal done, like a down payment of some kind, or maybe you don't require that, but they're going over your threshold for maximum loan to value and they need to cover the difference, you need to calculate the money they need at closing plus the reserve requirement and then document to make sure that they have that. So that's number one. And then a quick, as far as the deal goes, I like to see what the combined loan to value is going to be. So purchase price plus any construction, and then I divide it by the after repaired value. So those are the three numbers: purchase plus construction divided by value. And if I'm at or above 75%, I think the deal is too tight and I'm probably not going to spend time on it. If it's between 70 and 75, I think there's going to be profit, but I'm going to run a more detailed analysis of that. And you can find all of this on our website, but basically what you do is you start with the after repaired value and subtract all the costs to do the deal and just make sure that that bottom line, the profit number, is thick enough for you to feel comfortable letting your client get into the deal. If it's 70% or less, assuming the numbers are accurate, it's going to be a profitable and safe loan 100% of the time. So again, super quick: purchase, repairs divided by ARV. You want 75% or less. If it's over 75, it's probably not a strong enough deal for you to get involved in.
Got it. Okay, I like that.
Does that help?
Yep, it does. It's great.
One more thing on the insurance. It just seems so obvious, but it gets missed sometimes. Make sure you're listed as an additional insured on the policy.
Yes.
So if there's a loss and your client goes out and files a claim and gets awarded some money, they're not going to call and tell you and give you some of it. But if you're listed on the policy, you can control that. You want the money, you hold it in your account, and then you issue it back to them when the work, whatever the damage was to the house, when that's fixed and completed, then you give them the insurance money. If you don't get listed on the insurance, you will not get notified of that.